Thank you very much for joining us this morning. Today, we are going to be giving you an update on the trade credit insurance market. Joining myself, Prudence Chang, the Executive Manager of Business Development and Partners, we have James Thornbury, Managing Director of Australia for National Credit Insurance Solutions. We're really excited about presenting to you today. I feel like it's been a really long time for myself from being in front of a crowd. So this is as good as it gets apparently in the COVID world. But today we're going to be going through the market insights that we have. We've got a couple of partners that have provided us with some really interesting data. And we'll also be going through what the insurance market has got to say. So handing it over to you, James, to go through the NCI insights.
Great. Thank you very much, Prue, and a warm welcome to everyone who's joined the call. Look, for those that aren't familiar with NCI, we're the largest broker of TCI, or trade credit insurance, in the domestic market, and a leading provider of trade credit management solutions. Basically, our core purpose, which sort of drives us every day, and is the reason we all get out of bed, is to protect businesses from bad debts and to enable them to grow. Through our trade credit insurance and credit risk management services, we directly support just over $150 billion worth of trade on credit terms. And it's that large volume of trade that we support that we're able to build up a large pool of proprietary data that enables us to provide some unique insights and help businesses make better credit decisions. So hopefully we're also going to be able to provide some of those insights on the session today. It will give us a little bit of an idea as to what's happening in the market over the last 12 months and perhaps what's going to happen over the next 12 months. The data pool we're looking at contains more than 1.2 million businesses who purchase goods and services on credit terms. So look, with a gratuitous plug over, hopefully that provides some context to the data we're about to share here. We're going to have a little look in the rear vision mirror now and look at some of the data from the past 12 months. So you'll see up there on the screen a graph that plots the number and value of trade credit insurance claims supported by NCI over the past 12 months. Claims relate to non-payment of an account receivable due to either insolvency or protracted default. So you can see there, while the number of claims remain below historic levels, which is represented by the red line, we can see the value of trade credit insurance claims up sharply in November, December, and January, which is perhaps a sign of things to come. In terms of industries that are represented in these numbers more than others, building and hardware, electrical, and manufacturing are the key ones. So this next slide plots some of our NCI claim data against ASIC external administration data. So it shows the number of companies entering external administration against the number of claims received from our clients at NCI. So you can see there's a reasonably close correlation between the two. But you'll also notice that round about, if we could draw a line up from when COVID started, the pandemic started, both of these stats are lower than historic levels. So I guess the question again is, these levels are a lot lower than what we've seen historically, both claims and external administrations. And the big question is, when will it return to pre-January 2020 levels? Again, adding to that narrative, this next slide shows the number of incoming NCI collections. So it shows collection activity through NCI over the past 3 years, 2019 to 2021. Again, similar to the last slide, you'll see just after the pandemic hit in March 2020, a clear drop from levels that were previously sort of between 1,000 to 1,200 collections, down to where we are at now, the last quarter of 2021, 488. But a big drop off. Collection activity over the past 5 quarters has been half of where we'd normally see it. And also perhaps that's a sign that suppliers are showing a little bit more compassion when pursuing their debts, and maybe they've taken on the collective supporting role that I think a lot of Australia's been doing during the tough times. So some of the people on the call may have seen this before. So the MCI Trade Credit Risk Index is released quarterly and is acknowledged widely as a key indicator of risk in the market. It's a proprietary index developed over time and based on an aggregate of claims data, collection activity, credit limit decisions, and also overdue accounts. So you can see roughly from Q1 2017, it plotted along around about 800, 900, and then we saw a sharp jump up just in line with the pandemic hitting. And then since then, it's been a big plunge down. When it jumped to 1100, I think most of us thought that was a really strange event, that graph that represents risk in the market would fall so sharply and so suddenly. So the question is, why has it done that? And that'll lead into this model on screen. The big question is why, and I think it's clear that the combination of unprecedented support from all corners, including government stimulus, repayment holidays from the banks, a lot of corporate goodwill, and the ATO, which has been very generous in holding off on collecting their tax debts, which have now hit record levels. But we wouldn't expect that to continue for too long. And there's certainly a lot of evidence to suggest they're pursuing those a lot more vigorously than what they were. So the model up there on the screen, it may be slightly difficult to comprehend on the screen, but it is a really, really good model, and a big shout out to our partners at Deloitte for providing the model. Hopefully you can make it out to some extent. The black line represents the number of companies entering external administration. You'll see, well, hopefully you can see, it dropped sharply after stimulus measures were introduced by the government, which has supported, what we hear in the newspapers and the TV. It supported what they term so-called zombie companies. So the companies that have managed to survive and not enter insolvency that otherwise wouldn't have. And the grey shaded area you can see on the graph, that shows the number of external administrations that should have occurred if they had tracked to the 10-year monthly average. So basically what this graph shows, and it ties in with the narrative and the data that we've just showed you, these external administrations, they've been kicked down the road. The can's been kicked down the road, and the Deloitte model shows that we're likely not too far away from those external administrations becoming a reality. And that's the green that you can see on the graph that is showing from about May 2022 onwards, Deloitte are expecting all of those external administrations that haven't eventuated during the pandemic to come to reality. So this next slide, this is what we call and what we're terming the eye of the storm, which is probably fairly close to home for a few people in the northern parts of New South Wales and Queensland at the moment. So a big shout out to everyone there who's experiencing hardship. But the eye of the storm, I think, if you read the papers and watch the news, there's a lot of factors there, such as supply chain issues. We hear about raw material price increases, which feed into building and construction, which is potentially at a tipping point. Global tensions and what's happening in the Ukraine and Russia, and there's been a lot of tension around the trade scene with China for some time. inflation's predicted to keep spiking up. We've got record ATO debt, interest rates fairly likely to rise. Labour shortages, which is putting a lot of pressure on wages and the cost for labour, and of course, most people would have heard in the last week or so the collapse of a very large company, ProBuild. So just to quickly touch on ProBuild, because one we're really familiar with, it is the most prominent collapse so far in 2022, and it's what we would call is a fairly classic trade credit insurance story where, despite a lot of people covering this name, there were no warning signs or very little warning signs of what was to happen. They've gone down owing tens of millions to suppliers around the country, and massive flow-on effect to a lot of contractors and subcontractors in that industry, which is really painful for them. But thankfully, there's 57 relatively happy customers of NCI. So we had 57 customers where we had limits or helped to facilitate and support limits of $37 million in aggregate against ProBuild, and we're hoping to get claims paid as quickly as possible, as at 28th of Feb, and this is only something that really happened in the last week or so. We've already got $12 million of claims lodged, and we're hoping to have a lot of relieved and happy clients that they were covered by ProBuild. And it just goes to show that there's no company too big to fail, as we will get a quick glimpse on the next slide. So here's a sample of insolvencies probably over the past 5 years or so. I mean, as you'll see there, they're not limited to industry. They're across retail, building and construction, food, agri, mining, travel, clothing, retail. And there's some big names there: Dick Smith and One Steel, Arium, Roger David, Virgin. So it just goes to show that you never know who is going to be the next company to fail. You never know what's happening behind the scenes, and I think always better to be safe than sorry.
Absolutely.
So with that, Prue, I think you've got some great slides to show us after this. I'll pass over to you.
Thank you very much, James. And James is absolutely right. I mean, no business is too big to fail, and it really does show that it's important to have as much coverage as possible. We recently have met with the insurers. We've got a few more to meet over the coming weeks, but we have met with a vast majority of the insurers. When we do this, we do it every sort of 6 months. We chat with the insurers to find out where they're sort of heading, what they would like to see from the market, and how best to position, of course, our clients when negotiating with them on rates and, of course, on policy structures. So here, of course, you've got the insurers in the Australian market. I always have a joke around saying, we've got only a few to deal with in comparison to our friends in the general market that have literally hundreds. Each of these insurers does have specialist products available and wordings available. So they are quite different, although they do speak a similar language. So it's important that you're partnering with the right insurer for your business. So insurer appetite. We know that has certainly been on the decrease over the last 18 months due to, of course, what everyone knows. With the uncertainty of COVID came the uncertainty of certain industries. Those that we saw as being not COVID safe, or that's what we like to call them, such as hospitality, entertainment, travel, publishing and textiles, they were also too that the insurers started to wind back a little bit. They're actually becoming more and more interesting to be looking at. We do know that because the insurers have had less claims than usual over the last 12 months, it has caused them to really reassess their books themselves. And in the meetings, they certainly did all fly the flag to say that they are open for business. Now, what does that mean to you guys? I mean, that's the main thing. You want to know what that means to you. It means that they will be open to negotiation. They'll be open to discussing more about your business, what you need, and hopefully coming to the party. Certainly, the insurers are not the only way to mitigate your risk. So I speak to a lot of clients about what they actually require. Do they require their whole book to be covered, or do they require just a top echelon of debtors? There are ways to mitigate your risk, of course, at the front end, making sure that we are opening up credit accounts soundly, making sure that we are using appropriate information, such as NCI credit risk management, to be able to ascertain the credit worthiness of a debtor, and then, of course, monitoring that debtor in case of any sort of slow payments, repayment plans, collection actions, so that you can be proactive in collection of your debt and not be the last person standing. It is going to become vital over the next 12 months. We know that the squeeze is going to be put on to debtors, so we want to make sure that you guys are in the best position to be recouping your money as quickly as possible and in front of other people. So when we're looking at the insurers, it's really important that you look at them and you think this is a partnership. Certainly have a consistent approach when it comes to running of your business, exactly the same when it comes to negotiation with insurers. Be able to negotiate. There's so many things within your policies that you can actually look at changing, whether it be your indemnity, which is usually set at that 85 to 90%. You might want to see that as being a little bit lower. It might be your excess points. I only met with someone this morning that traditionally had a $5,000 excess and hadn't changed their structure for many, many years. Over 5 years, they'd stayed with the same structure. And we're now entertaining the thought of actually raising that excess up to $10,000 and seeing what effect on the premium that will have. I certainly believe that we will be able to negotiate with the insurer for a lesser premium if we are raising those excess points. Have a commercial approach. So we want the insurer to have a commercial approach to your business. So if they feel as though that there is some risk in there, we want to be able to communicate with them that they can take some risk, and of course we'll take some risk. So there needs to be a commercial approach, not just a blanket of no, I won't do something. We want an insurer, of course, that has got good communication and that really understands your business. And it's important that you are partnering with a broker such as NCI to be able to facilitate that soundly for you. There's a lot of management that goes into these types of policies, and we certainly do have the back end capabilities to be able to support you guys moving forward. One thing that I do ask the insurers often when we are renewing policies is, how would you like to see this premium reduced? How would we make it so that you are comfortable in reducing this premium? What can we actually do? So by asking that question, it's putting you guys, our clients, in the box seat to be able to negotiate with the insurer and find out exactly where they're seeing your policy land. So just to go over trade credit insurance again, for those that might not be so familiar with it, it is the insurance of insolvency or protracted default, which is really fancy terminology for non-payment against debtors. Normally, it's set at 85 to 90% of the debt that can be recovered via the credit insurance. Rates are usually sitting between 0.05 to 0.6%. However, I actually got some figures run this morning, and NCI's average rate is actually sitting at 0.35%. So as you can imagine, it does become quite viable. And now is the time, if you are going to look at purchasing trade credit insurance, that you should do it. Before, as James said, we head into that eye of the storm and claims are going through the roof, because as we know through even general insurance circumstances, if there are a lot of claims within a certain product, that product price usually does go up. So we certainly don't want you to be in that position. It, of course, preserves your profit, strengthens your credit management procedures. So it does allow you to transfer that credit management over to the insurers for the higher accounts, where they can help you to open them and determine whether they are worthy for your credit and your work. It protects your liquidity and cash flow, of course, by having that injection of cash flow back into your business rather than just having a bad debt. Of course, it increases profit. Now, this is a really interesting one. Often clients will come to me and say, I want to work with XYZ for, say, 100,000. I'll go to the insurers, and the insurers will say, I've actually got a bit more capacity. I might be able to give you 150. So we're then able to go to our clients and say, hey, look, we've got 150,000 in the market rather than 100. Could you take on another job? So that will, of course, increase the profitability and the working with that debtor. It adds security and, of course, enhances finance. So there is a lot of chitter chatter around banking and finance and second tier funders around using trade credit insurance as security. And I'm sure that they would be more than welcoming to that conversation if you are looking at borrowing any funds. If you are, please do engage an NCI. We can certainly help with that conversation. So even if you don't have trade credit insurance, I do think this is a really valuable exercise for you to do with your ledger on a yearly basis. Certainly look at your debtor ledger, conduct a spread of risk, ensure that you actually understand your credit procedures and are they working for the business at this point in time. Business has changed, it's moved. Something that you may have introduced to the business in a procedure 10 years ago may not be relevant now, and you might be able to tweak it a little bit to ensure that your daily sales outstanding figure actually becomes lower. We want to review major customers on a yearly basis at least, because we do see the solvency of larger customers change quite regularly. I liken it to a photo. You take a photo today, but tomorrow that photo will move and it will change. So it's important that that photo is retaken every 12 months at least to make sure that you're in the best position to know what's going on with your debtors. We can certainly help you out with that by utilising NCI credit risk management. Make sure that you've got reliable security. So that might be security in the way of contracts, credit application forms, trade credit insurance, of course. It could be in the form of guarantees or bonds. There's various ways that you can actually gain security when you need it. And of course, the trade credit insurance is that last gap and the stoppage of the business that will help you sleep better at night because it will insure you against the financial loss of that bad debt. So NCI would like to give you guys a little bit of a present. We would like to assess your top 10 customers for you. All you have to do is email info@nci.com.au. We wish to assess these for you and give you an indication on their viability and the credit limit, and make sure that you're dealing with really sound customers and make sure that you know everything that you can about those customers, of course. So now we're going to open up the floor to any questions. James, I'll just take you off mute now and just see if we've got any questions. And we might have Daniel, can you see whether you can see any questions as well?
Hi, Prue. No questions from my side at this point.
Okay. So one question I did have was about structure. How often do you see other structures coming into play, and can you ask for additional structures in quotations? So the answer is absolutely. Often I would like to go to the market with at least 2 different structures when negotiating, because we want to see not only what you've presently got and what that would be priced at, but also what would it be priced at if we did raise an excess or if we did lower an indemnity. It's really important to have those situations placed to the insurers so that they can come back with some viable options for you. Another question that I've got here, did NCI know about the ProBuild collapse? If not, why was it such a secret? James, do you want to answer that?
Well, I think the ProBuild collapse was very similar to a lot of those other big names we showed on the slide of other companies that have gone insolvent, like a Dick Smith. They're obviously operating in an industry where there's cost pressures, there's supply chain issues, there's labour shortages, and there's a lot of fixed price contracts. So certainly nothing that we or the insurers saw before it happened, or the banks for that matter. So it's one of those ones where I think if it represents a significant number when it comes to your sales, if they're a key buyer, I think it's better to have some sort of credit risk management practice, which includes trade credit insurance to ensure that you do get paid out if there is a collapse.
Absolutely, James. You're quite correct. Sometimes we just don't know. And that's why we have insurance. Just similar to you don't know what type of car crash you're going to have, you would insure your car. It's exactly the same premise with the trade credit insurance. With ProBuild and a lot of the others, I know that there were lots of tradies still on site up to the date in which it happened. And it just happens sometimes, unfortunately. On the flip side, however, we do find out a lot of information about companies that are failing slowly. So often we do see payments coming through on the month-to-month reporting that could occur. So each policy is requested to let the insurer know via NCI of an account that could be over 90 days and the reason why. If we see a trend happening with a debtor, that does flag us to investigate that debtor further and really look into the solvency of that debtor and the risk that could be pronounced to our clients. There are often circumstances where we could ring clients and say, look, this is happening. Have you seen it? Are you feeling it? What's going on? And that would be a basis for us to have a further investigation. And that's usually what the insurers would do also. But James is quite correct. Sometimes these things just happen, and that's why you need the protection in place. Okay, I've got another question here. What is the general turnaround time on covered claims? That's a really good question. So general turnaround time on claims that are covered, it really depends on when you're getting your paperwork in. As long as you can get all your paperwork in, and we have a checklist, of course, that we provide to clients to make them feel more secure about what they need to have ready in a claim situation. The claim is usually paid within 30 days from the date of the first circular being had, so the confirmation of debt. So once the confirmation of debt is supplied to the insurer, we usually see claims paid within 30 days. Now, within 30 days, can I say, I've seen claims get paid as little as 24 hours after confirmation of debt. So I always explain to people the confirmation of debt is, of course, the golden slipper that we need to then ask the insurers for that EFT payment into your bank account.
Important to note also, Prue, that we have dedicated teams to help clients work through claims. It's not it's not the broker that sells the policy, manages the policy, that then does a claim. We do have that, as Prue mentioned earlier, the back office support, the infrastructure and the teams in claims, in collections, in negotiating limit decisions. So I think on average, you would find that the process is significantly smoother and quicker.
Absolutely, absolutely. And certainly with the ProBuild collapse, I know that our claims team was on the phone discussing with clients who did have quite extensive exposures what they needed to do next. Did they have everything organised? Can we help at all? So we were doing that within a matter of hours from finding out about the collapse, which was just terrific. And it certainly does show why it's important to be with a specialist that has expertise in all areas. So another question that I've got here, does the 30-day claim payment timeframe include protracted default scenarios? No, it doesn't. Protracted default is a prolonged period of non-payment for those that didn't know on the call. During this time period, there is a waiting period that does occur with each of the insurers. In that waiting period, we have to have seen to have gone down the collection route, possibly the legal route, so that can take some time. The claim protracted default period is usually within 3 to 6 months, depending on what we can negotiate. There are also some insurers, however, that can pay out faster depending on the situation. So if you do have a policy in place, please talk to your broker about the particulars around the claim payment to do with protracted default and that particular insurer. Okay, I don't think I've got any other questions coming through. Thank you very much for providing us with some questions. It's always nice to see people interested in our content. We look forward to hopefully seeing you guys out and about face-to-face very soon. But if you've got any further questions, please do reach out to NCI, one of the representatives. Don't forget to email info@nci.com.au to have your top 10 debtors assessed by us. And we look forward to hearing from you. James, any other words?
No, I think you've summed it up very well, Prue. Thanks everyone for joining. It's been a pleasure to have 30 minutes of your time to present hopefully what's been some informative information, and we certainly look forward to meeting a few of you face-to-face in the near future. Excellent. So thanks very much, and thanks, Prue. Great job.
Thanks, James. Excellent. Have a good day, everybody.
Thanks. Bye all.